Oil above $100, long bond yields above 5%, yet equities are still leaning on AI-fueled earnings. That collision of energy shock, inflation risk, and structural growth is defining the current equity landscape. Welcome to vTalkInsight, Equity Pulse Daily for May 6, 2026. Let us unpack what is driving equity risk and opportunity right now. At the macro level, equities are navigating a classic energy shock layered onto an already fragile rates backdrop. Escalating hostilities in the Strait of Hormuz, including missile and drone attacks on vessels and oil infrastructure, have choked off normal traffic and forced significant rerouting. Tankers are clustering around safer Gulf ports, production in parts of the region is constrained by logistics and storage, and inventories are being drawn down. Brent is holding above $100 a barrel, and markets are starting to discuss scenarios where crude could spike toward $180 this summer if conflict and shortages persist. In that case, Europe and parts of Asia look most exposed to recession risk, given their dependence on imported energy and sensitivity to transport costs. Refined products are amplifying the problem. Global jet fuel exports have dropped sharply, already triggering notable flight cancellations, while U.S. refiners are diverting more jet fuel and diesel to Europe, Africa, and Asia. That helps plug shortages abroad, but points to higher domestic fuel prices and more pressure on travel, logistics, and other fuel-intensive sectors if product prices stay elevated. All of this feeds directly into the inflation and yield story. Headline U.S. inflation is now expected to push above 4% in coming months as energy passes through, and survey data such as the ISM Services Prices Paid Index underscore broad cost pressures. Structural forces are pushing the same way, with tariffs, tighter immigration, and a powerful wave of capital spending in semiconductors, energy, and AI infrastructure described as inflationary in the near term, even if productivity gains from AI arrive only with a lag. Bond markets are repricing around this backdrop. U.S. long-term yields sit near multi-decade highs, with the 30-year above 5% and the 10-year approaching 4.5%, helped by a sharp step-up in Treasury issuance and similar supply concerns in the U.K. Central banks such as the Reserve Bank of Australia are already tightening again. The European Central Bank is signaling further hikes despite fragile demand, and in the U.S. the debate is shifting toward whether the Federal Reserve will effectively tolerate inflation above target for longer. That mix of higher inflation risk, heavy issuance, and more restrictive policy tightens financial conditions before growth has fully recovered and leaves equities facing a higher discount rate and a more volatile cost of capital, just as energy squeezes margins. With that macro backdrop, the micro tape still looks surprisingly strong but also increasingly uneven. For the first quarter, S&P 500 earnings growth is tracking around the mid-teens, with well over 80% of companies beating expectations and profit growth roughly double what analysts forecast going into the season. Earnings are rising faster than share prices, so headline valuations have edged lower even as profits climb, which is helping support a constructive tone toward equities despite war, oil, and yield headlines. Even with U.S. 30-year yields above 5%, the S&P 500 has recently advanced, and the main volatility index is parked in the high teens, underscoring the gap between cautious macro commentary and still resilient risk pricing. Gains beneath the surface are far from broad-based. Leadership is concentrated in a relatively small group of high-growth, often AI-focused names, while the equal-weight S&P 500 has fallen in 9 of the last 10 sessions. Commentary points to a clear preference for scarce, visible growth as uncertainty about the broader cycle rises. In Europe, energy stocks are leading sector performance, helped by elevated oil prices, while travel and leisure names are under pressure as fuel costs and the risk of flight disruptions mount. Regionally, European markets are softer overall, with Germany lagging and Italy showing relative resilience, supported in part by bank exposure. That divergence reflects both sector mix and differing sensitivities to the energy shock, and it reinforces the idea that regional allocation is increasingly about which indices offer either energy leverage or financial sector earnings momentum. Bank earnings themselves underline the split. UniCredit has posted record quarterly profit, with net income up in the mid-teens and strong fee income strengthening its position as a potential cross-border consolidator, including a possible bid for Commerzbank. Management is delivering robust shareholder returns and efficiency gains, though questions remain about how long growth can rely on cost-cutting. HSBC, by contrast, has missed profit expectations after a roughly $400 million fraud-related charge linked to the collapse of a UK lender and a $300 million increase in loan loss provisions tied to a weaker outlook and Middle East tensions. The stock has surrendered recent outperformance, and the surprise nature of the loss has raised concerns about risk oversight and earnings quality. UBS may get some relief if Swiss capital requirements are delayed or softened, but that also prolongs regulatory uncertainty. Beyond the listed banks, private credit is becoming a more important barometer. The market continues to expand, particularly in Europe, where it is being asked to finance large needs in defense, sustainability, and innovation, while in the U.S. retail participation has grown rapidly over the past 5 years. Institutional investors are showing renewed interest as some capital exits and spreads widen. At the same time, regulators, including the SEC, Treasury, and Federal Reserve, are stepping up scrutiny, investigating potential fraud, and signaling that defaults are likely to normalize from very low levels. Troubled borrower rates remain low for now, but managers expect elevated redemptions and a modest rise in defaults, so this part of the market is increasingly central to how tighter policy transmits into mid-sized corporates. Micro signals from cyclicals and consumer names round out the picture. Shopify's softer guidance is being read as a sign of more cautious online spending, while on semiconductors' weaker outlook for industrial and auto demand hints at a slower recovery there. On the other side, Anheuser-Busch has delivered its first volume growth since 2023, helped by Latin America and an upcoming World Cup, and Novonesis is growing around 7% with bioenergy and household care offsetting softness in North American probiotics. European defense groups such as Rheinmetall are maintaining very strong medium-term growth and margin targets, but sector share prices have traded broadly sideways despite persistent geopolitical tension, implying that much of the positive story is already reflected in valuations. Overall, index-level earnings remain robust, but dispersion across sectors and issuers is widening, and markets are becoming more sensitive to incremental news in areas directly exposed to oil, rates, and credit. One reason headline indices can look past near-term macro shocks is the scale of structural forces now in play, and AI sits at the center of that. Commentators describe AI and related technologies as a mega force reshaping the global economy, with the U.S. expected to lead a sustained capital expenditure boom and, over time, stronger productivity growth. The catch is that this investment wave is inflationary in the near term, even if the efficiency gains arrive later. The infrastructure numbers are striking. Hyperscaler order backlogs have accelerated from growth of roughly 20% a year ago to well over 100% in the latest quarter, signaling a major inflection in demand for compute and data centers. Despite investor unease about rising capital spending, these platforms are still generating cash returns on investment close to 30%, and last year the Street materially underestimated both capex and revenue growth for the AI leaders. Moody's now projects more than $3 trillion of data center investment globally over the next 5 years, and recent financings are increasingly investment grade as major tech firms absorb more project risk to broaden their funding base. Company-level signals line up with that story. Meta plans a $10 to $13 billion data center in El Paso and is expected to raise debt against it, with strong appetite anticipated. Alphabet is launching a record Eurobond deal to fund AI-related capital expenditure. Prysmian is committing over €1.2 billion to expand U.S. cable capacity, aiming to lift optical cable output by up to 50% and targeting about $5 billion of revenue from hyperscaler contracts within 5 years. Management there even sees scope to upgrade 2026 guidance if these deals are finalized, and is pursuing further M&A in electrification and optical cables, aided by U.S. aluminum tariffs that favor its domestic production. Supply chains are shifting alongside this investment. Apple is in early talks with Intel and Samsung to manufacture processors in the US, explicitly to diversify away from a single Asian foundry and reduce geopolitical and supply risk. The prospect of winning that business has already boosted Intel's share price and underlines how AI demand and geopolitics are rewiring the semiconductor landscape, with potential long-term implications for margins and market share across the industry. At the same time, the policy backdrop around AI is evolving quickly. U.S. authorities are weighing stricter oversight of powerful models, including possible pre-release national security reviews. That could entrench incumbent megacaps that can manage the regulatory burden, yet it also raises headline and execution risk and may slow innovation at smaller rivals. For equity markets, the AI complex remains a central growth engine, but one tightly intertwined with inflation, regulation, and supply chain realignment rather than operating in isolation from the rest of the economy. The equity backdrop right now is defined by three intersecting forces. A severe energy shock centered on the Strait of Hormuz is lifting inflation and tightening financial conditions, just as government bond markets digest heavy issuance and multi-decade high yields. At the same time, corporate earnings, especially in the U.S., remain robust, but leadership is narrow and dispersion across sectors and balance sheets is widening, with banks, private credit, and consumer cyclicals all sending mixed signals. Overlaying that is a powerful AI-driven capital expenditure boom, which is a genuine growth engine but also an important source of near-term inflation and regulatory uncertainty. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.